Have you ever wondered where companies raise billions of dollars, governments borrow money, currencies are exchanged every second, and investors grow their wealth? The answer is simple: financial markets. But here's something many beginners don't realize. The financial market isn't just the stock market. There are actually several different types of financial markets, and each one plays a unique role in the global economy. Some help businesses raise capital. Some allow governments to borrow money. Some let traders buy and sell currencies. Others deal with commodities like gold, oil, and wheat. Understanding these markets is one of the first steps toward becoming a smarter investor. In this video, we'll explore every major type of financial market, how each one works, who uses them, and why they matter. Let's begin. What is a financial market? A financial market is a place, either physical or digital, where buyers and sellers trade financial assets. These assets include Asia, stocks, bonds, currencies, commodities, derivatives, mutual funds, cryptocurrencies, and many more. Think of a financial market as a giant marketplace. Just like people visit a supermarket to buy groceries, investors visit financial markets to buy and sell investments. These markets help money flow efficiently through the economy. They connect people who have money with people or organizations that need money. Without financial markets, businesses would struggle to expand, governments would find it difficult to finance projects, and investors would have limited opportunities to grow their wealth. Why are financial markets important? Financial markets perform several essential functions. They help businesses raise capital. They allow investors to earn returns. They improve liquidity, meaning assets can be bought and sold quickly. They help determine fair prices through supply and demand. They distribute financial risks. And perhaps most importantly, they support economic growth. Every developed economy depends on efficient financial markets. Type 1, stock market. The stock market is the most well-known financial market. This is where investors buy and sell shares of publicly listed companies. When you buy a stock, you're purchasing a small ownership stake in that company. If the company grows and becomes more profitable, your investment may increase in value. Some companies also reward shareholders through dividends. Example, imagine purchasing shares of a technology company. If the company launches successful products and earns higher profits, more investors may want to buy its shares. As demand increases, the stock price may rise. If you decide to sell later, you could earn a profit. However, if the company performs poorly, the stock price could fall. That's why investing always carries some level of risk. Type 2, bond market. The bond market is where governments and companies borrow money from investors. Instead of selling ownership, they issue bonds. A bond is essentially a loan. When you buy a bond, you're lending money to the issuer. In return, they promise to repay the principal amount, along with regular interest payments. Bond investments are generally considered less risky than stocks, although returns are usually lower. Example, a government may issue bonds to build highways, hospitals, schools, or public infrastructure. Investors receive periodic interest until the bond matures. Type 3, money market. The money market deals with short-term borrowing and lending. These investments usually mature within 1 year. Participants include banks, governments, corporations, and large financial institutions. Money market instruments are known for being highly liquid and relatively low risk. Examples include treasury bills, commercial paper, certificates of deposit, repurchase agreements. This market helps organizations manage short-term cash needs. Type 4, foreign exchange market, Forex. The foreign exchange market, commonly known as Forex, is where currencies are traded. It is the largest financial market in the world. Trillions of dollars change hands every single day. Currencies are always traded in pairs. Examples include TT, US dollar and euro, British pound and Japanese yen, Australian dollar and US dollar. Participants include banks, central banks, governments, corporations, hedge funds, retail traders. Example, suppose a European company wants to buy products from the United States. It may need to exchange euros into US dollars before making payment. That transaction takes place in the Forex market. Type 5, commodity market. The commodity market involves trading physical goods. These include hard commodities, gold, silver, crude oil, natural gas, copper, soft commodities, wheat, coffee, cotton, sugar, corn. Commodity prices change based on supply and demand, weather conditions, political events, and global economic trends. Example, if poor weather reduces wheat production, prices may rise because supply decreases. Similarly, geopolitical tensions can increase oil prices. Type 6. Derivatives market. The derivatives market may sound complicated, but the basic idea is simple. A derivative is a financial contract whose value depends on another asset. That underlying asset could be stocks, commodities, bonds, interest rates, currencies. The two most common derivatives are futures options. Investors use derivatives for hedging risk, speculations, portfolio management. Because derivatives can be highly leveraged, they also carry higher risks. Type 7. Capital market. The capital market helps businesses and governments raise long-term funds. It includes both its equity markets, bond markets. Capital markets are divided into two major segments. Primary market. The primary market is where securities are issued for the first time. This is where companies raise fresh capital. The most common example is an initial public offering or IPO. When a company goes public, investors purchase newly issued shares. The money goes directly to the company. Secondary market. Once those shares begin trading among investors, they enter the secondary market. Here, investors buy and sell shares from one another. The company itself does not receive money from these transactions. Stock exchanges are part of the secondary market. Type 8. Cryptocurrency market. The cryptocurrency market has become increasingly popular over the past decade. Unlike traditional financial markets, cryptocurrencies operate on blockchain technology. Popular digital assets include Bitcoin, Ethereum, Solana, XRP. These markets operate 24 hours a day, 7 days a week. Although cryptocurrencies offer exciting opportunities, they are also highly volatile. Prices can change dramatically within hours. Investors should always conduct thorough research before investing. Type 9. Insurance market. The insurance market helps individuals and businesses protect themselves from financial losses. People pay premiums to insurance companies. In return, insurance companies provide financial compensation if covered events occur. Examples include health insurance, life insurance, auto insurance, home insurance, business insurance. Insurance reduces financial uncertainty and supports economic stability. Type 10. Mortgage market. The mortgage market focuses on home loans. Banks and financial institutions lend money to people purchasing homes. These loans may later be bundled and sold to investors as mortgage-backed securities. A healthy mortgage market plays an important role in the real estate sector and the broader economy. Who participates in financial markets? Many different participants keep financial markets functioning efficiently. These include individual investors, banks, investment firms, insurance companies, governments, central banks, corporations, mutual funds, pension funds, hedge funds, institutional investors. Each participant has different objectives, but together they create liquidity and keep markets active. How financial markets affect everyday life. Even if you've never invested, financial markets influence your daily life. They affect your retirement savings, loan interest rates, home prices, job opportunities, business growth, inflation, currency exchange rates, fuel prices, food prices, and even the performance of your country's economy. Financial markets impact almost everyone. Risks of financial markets. Although financial markets create opportunities, they also involve risks. Some common risks include market risk, inflation risk, interest rate risk, currency risk, liquidity risk, credit risk, political risk. Understanding these risks helps investors make informed decisions. Tips for beginners. If you're just getting started, remember these important principles. Learn before investing. Diversify your investments. Invest for the long term. Avoid emotional decisions. Research every investment carefully. Only invest money you can afford to keep invested. Continue improving your financial knowledge over time. Successful investing is usually built on patience and discipline rather than quick profits. Financial markets are the foundation of the global economy. They help businesses grow, governments fund projects, investors build wealth, and economies expand. Whether it's the stock market, bond market, forex market, commodity market, cryptocurrency market, or derivatives market, each serves a unique purpose. Understanding how these markets work gives you a stronger foundation for making smarter financial decisions. Remember, knowledge is one of the most valuable investments you can make. The more you understand financial markets today, the better prepared you'll be for tomorrow's opportunities. If you found this video helpful, give it a thumbs up and share it with someone who wants to learn about finance. Subscribe to BNR Universe and turn on the notification bell for more easy-to-understand videos about investing, stock markets, personal finance, business, and the global economy. Thanks for watching, and I'll see you in the next video.